Today I'd like to talk about stock options, which are very similar to restricted stock units or RSUs. They're another very commonly awarded type of equity compensation, but there are a couple of key differences that are important to understand. The most important difference is that when you are granted stock options, you are not actually being given company stock. You're only being given the option to buy company stock. What that means is if you have been granted stock options by your company, when those options vest, again, you are not actually receiving any stock, you're only receiving the option to buy your company stock at a predetermined price. If stock options are part of your compensation package, you will receive a grant document. In the grant document, you will have a vesting schedule, and the vesting schedule is typically something like monthly or quarterly over a period of 3 or 4 years. Again, when those options vest, you actually haven't received anything other than the option to buy your company stock. The other information in your grant document that you'll want to look for is the strike price or the exercise price. So those two things are interchangeable. And that just refers to that predetermined price at which you are now able to buy your company stock. For example, if your grant document designates the exercise price at $5 a share, it doesn't matter what your company stock is actually trading at on vest day, you are now able to buy a share of stock for $5 a share. And if it's actually trading at $25 a share, you are free to turn around and sell it and pocket the difference, or you can choose to hold the stock. So the stock option gives you just the ability to buy your company stock at that set exercise price or strike price, which does not change. So once it's established in the grant document, regardless of what the fair market value of your company stock might be in the future, the exercise price will not change. The other important thing to know about stock options is how they are taxed. And there are two different types of options, and the primary difference between those two types is really just in how they are taxed. The first of the type of options is called incentive stock options, also known as ISOs, and the second type is non-qualified stock options, or NSOs. Incentive stock options are the more complex version from a tax perspective. So what happens when you have stock options is on the day of vest, there is no tax due. There is not a taxable event. You haven't actually received anything. So the vesting on its own is not a taxable event. Once you exercise your stock options, you are potentially triggering a taxable event. If it's an incentive stock option, you might owe tax, you might not owe tax. And that will depend on your personal tax situation, your income, and a variety of other things will determine whether or not that is a taxable event. The pieces of information that you'll want to help you determine that will include the strike price or the exercise price, and then the value of the company stock when you exercise. So again, in that example we used before, if your company stock is trading at $25 a share, your strike price is $5 a share, you're interested in that difference. $25 minus 5 is 20, times however many shares you exercised becomes your bargain element. So the bargain element is the piece of information that you're going to bring over to your tax person, and they will be able to calculate whether or not that is a taxable event. If you are dealing with incentive stock options, I strongly suggest that you work with a qualified CPA, tax preparer, but specifically somebody who knows how stock options work and how they are taxed. The majority of people who do taxes are not very familiar, and it's very easy to make a mistake. But that bargain element, again, the fair market value minus the strike price times the number of shares that you've exercised, the bargain element is the most important piece of information that's going to help you determine whether or not taxes are due. With non-qualified stock options, it's more straightforward. The same bargain element is the key piece of information that you're looking at. And as soon as you exercise your non-qualified stock options, that one definitely is a taxable event, and that bargain element will be fully taxable at whatever your income tax bracket is from a federal perspective, state, Medicare, and Social Security. So you take your bargain element, and if you're in the 35% tax bracket federally, and whichever bracket you're in from a state perspective, you can be guaranteed that that bargain element will be fully taxable. In the future, when you then sell those stock options, assuming you sell them at some point, there may also be additional tax due, and that will be based on the value the day that you exercised versus when you then sell, and you'll be looking at some kind of capital gains tax, either short or long term, depending on how long you held and whether or not the share price actually increases or decreases in value. So we won't go too far into the different variations on selling, but there is likely to be a tax bill due again when you sell. So as you can see with stock options, there are a number of decisions that must be made, unlike restricted stock units, where really the only decision is when to sell them. With stock options, you have to decide if and when to exercise, whether or not to hold them, and then whether or not to sell, and when to sell at some point in the future. So there is a lot to consider. The taxes can get quite complex, particularly if you're dealing with incentive stock options, and it really does benefit you to work with somebody who understands the complexities that go into exercising, holding, and then selling stock options. At Zena Financial Planning, that is our area of expertise, and if you're interested in working with us, we are open to new clients.